This episode is brought to you by Blockdaemon. You'll be hearing all about them later from me later in the episode, but now on with the show. What's up, everyone? Welcome back to another weekly roundup edition of On the Margin. I am joined by my bombastic co-host, Mr. Mark Yusko. Mark, welcome to the show.
Wow, yes, that I've been described as that many times. In fact, I tell the story all the time. My wife saw me speak one time, and she said, "You can't say things like that." I'm like, well, what'd I say? She says, no, you say things so forcefully. So what's wrong with that? She says, well, people will believe you. Like, that's the whole idea. She says, what if you're wrong? I said, I'm wrong all the time. It's changed my mind. All right. So it is hot, like super hot down here in North Carolina, hurricane hot almost, which we'll get to. But so I'm not wearing socks, but I brought my socks because this is important. I mean, I have now these are the cold storage socks from Out Socks, but I'm using it for, and cold storage is good, but I'm using it for crypto winter. Winter is raging. I mean, raging, like a whole bunch of stuff going on. We're probably going to talk about it in terms of layoffs and downsizing and, doesn't mean there's not enthusiasm in the market. There is. I was just out in Seattle for a conference, and there was plenty of enthusiasm. But winter is going to be with us for a while. So,
yes, yeah, it certainly will. And when it comes to layoffs and everything, I mean, that is not something that's isolated to crypto markets in general. I mean, you can see this broadly reflected across the tech sector, but also just the economy writ large, I would say. Yep. So we've got a whole bunch of different stories to move through today, guys. What we're going to be kicking things off with is actually this Jamie Dimon, very colorful language here. We're talking about bracing for an economic hurricane. That's going to lead into kind of some of our talk about, layoffs and all that kind of thing. But, Jamie Dimon, he made some waves, in recent weeks. He talked about
well done. Made some waves, pun intended. I like it.
Wow, I didn't even mean to do that. Look at that.
I like it.
I appreciate it. Giving me too much credit, though. I'm just saying words. But he said this in a room full of analysts. So, Dimon was warning about three things here, right? So he's worried about quantitative tightening. That's scheduled to begin this month. Crazy that it hasn't even begun yet. But they're talking about, I think, something like $47 billion a month in terms of QT spread between treasuries and mortgage-backed securities.
Take the under.
And they're talking about ramping that up to $95 billion.
Yeah. Take the under. Way under.
Soon. All right. So that's one factor. He's talking about, worried about the war in Ukraine, and oil could hit $150 or $175 a barrel. And basically this is going to translate into them being much tighter with their balance sheet, JP Morgan, than they have been historically. So what's your take here in general when you hear a guy like Jamie Dimon saying this stuff, Mark?
God, Jamie. I mean, bombastic.
Jamie.
There's a guy who is bombastic. I mean, where was Jamie talking about higher oil prices when their firm was saying oil was going to never see $100 again? I mean, so and the war in Ukraine, it's just a dumb topic. The oil problem has nothing to do with the war in Ukraine. I mean, it just doesn't. It has to do everything with lack of investment into infrastructure around oil and gas and massive numbers of bankruptcies that took supply out of the market. But it didn't just happen now. This happened 2 years ago. We went super long energy 2 years ago because of this JB Investments. We've talked about this. And we made a ton of money for clients on, if it weren't for that, actually, our funds would have gotten crushed because of all the tech wreck, the Tiger Cubs getting just absolutely destroyed. And I mean, we don't have money with Melvin, but Melvin shutting down. So all kinds of crazy stuff. But this idea that, I mean, he's reporting the news. He's literally like a weather forecaster, right? He's just reading the teleprompter saying, Jamie, these are things we should talk about. Quantitative tightening, to your point, the Fed hasn't done anything. The market already did it. The Fed has raised 75 basis points on the Fed funds rate, which nobody uses. But interest rates spiked all over the place from the 2-year to the 10-year. And the amount of liquidity that gushed out of the market, right? More like the the wave after the tsunami when it recedes. That's the problem. So Jamie is trying to, I don't know what he's trying to do. He's trying to obfuscate the fact that he don't want to lend. Well, it's not that he doesn't want to lend. It's that nobody wants to borrow. Everybody is full up on debt, and they're gonna control their balance sheet. Yeah, that's your decision, Jamie. Right. I mean, it has to do with there's no demand for debt, and I don't know. Yeah, I'm not a big fan, actually.
I mean, to his credit, I mean, he did say one of the big differences, right, between what's going on now and the financial crisis in 2008, is the desire for, global desire for US Treasuries, right? So he's talking about, central banks, commercial banks, foreign exchange trading firms as those kind of being the three major buyers of U.S. Treasuries. And he says one thing that, might actually be different this time is that some of those players don't have the capacity or the desire to soak up as many U.S. bonds, right? And
100%, which is why take the way under on the central bank, to, lowering their balance sheet. It's just not going to happen. There is massive need for financing because of the deficit. And everyone says, "Oh, but the deficit is much smaller." Yeah, it's only $1 trillion now, down from $3 trillion. Okay, the budget, in theory, is supposed to balance, right? If you are going to spend money, you should probably take in some money that you can spend. That's how families work. But this idea that who's going to buy the bonds? I will give the point merit. Chinese aren't buying. Japanese aren't buying. Russians aren't buying. The FX. I mean, that's one of the things you can see in the yen, right? The dollar yen normally during hurricanes is really strong, but the yen has just gotten obliterated this year. And the reason it's usually strong is because of the unwinding of this yen carry trade. But nobody's doing that anymore. Not nobody, but there's much lower demand for global arbitrage of all types. And hurricane is the right term. I mean, it's absolutely the right term. And we're starting hurricane season down here in the Southeast, and they just announced the first tropical storm heading for Florida. So hurricane's absolutely the right term. Like most things, when non-economists get up and try to play economists, it's probably not something we should all pay a lot of attention to.
Yeah. I mean, and the last thing maybe I'd want to get your take on here before we move on is just sometimes it's hard for me to know how to interpret statements like this when guys like Jamie Dimon specifically say stuff like this. Yeah. Like, what it kind of gives me the vibe of is, Bill Ackman in March of 2020 vibes, saying hell is coming, right?
Yeah.
And it's kind of like, at that time, first of all, I will just say, I think I get it. Everyone's got to play their game. I understand that that's the game that hedge fund managers play.
Yeah,
I thought that was a little irresponsible at the time. I mean, in the grips of a panic, I just thought that was crazy. By the way, he was calling for 6 or 7% interest rates. Bill Ackman is on Twitter saying we need to normalize rates to 6 or 7%. What would that do? I mean, that would break. Nothing. I mean, I don't think anyone's calling.
He's a dork. Look, he's just an arrogant dork that thinks the rules don't apply to him. I mean, what he does by going on television like that is a form of stock manipulation, right? 100% a form of stock manipulation. If you get up and you say things to affect something that impacts what you already hold, right? Telling people that, the world is ending because you're short already. Now, there's no law against that, I guess. I mean, there should be, but there isn't. People do it all. I mean, the big guys do it all the time. But, look, here's the thing. If the Fed were to raise interest rates to 7%, how many ships in the Chinese harbor would that allow to dock and unload and reload? 0. If the Fed raised rates to 7%, how many less casualties would there be in Ukraine? 0. If the Fed were to raise rates to 7%, how much faster would the XL pipeline get approved? 0 days. None of the things that the people think the Fed has power over are impacted by interest rates. What's impacted by interest rates is the chart you have on the screen.
So this is net interest paid by the federal government. I just thought this was a cool chart. So basically what you're looking at here is the interest that's owed by the federal government at current interest rates, or what it actually, what we've actually owed over the last 12 months, which is $404 billion. And then they're kind of giving you different scenarios here, right? If we were to multiply interest rates from where they are now. And you can pretty quickly see, right, that as you go, times 2, times 3, times 4, the amount of interest that the US government owes creeps up from kind of 440 billion to, at, a 4 times multiplier to almost $1 trillion, right, on an annual basis, which is, even for the United States now, right, I know we don't shy away from deficits. That's a really large number. And I think, to reconnect this to what Jamie Dimon was saying, that becomes a problem when there's less global demand for US Treasuries, which is how we fund ourselves. Mm-hmm. The caveat to that, right, is that I think we are already the largest buyer. The Federal Reserve is already the largest buyer of treasuries. Right. And it's very unclear to me, at least, how much longer it seems like there's more room to run in that game, so to speak, right? If you look at Japan as kind of the poster child for this, right? Like, how many JGBs does the Japanese central bank own? I mean,
74%.
There you go. So, I mean, you could say that that's different with the United States, but
not different.
I'm just not
different.
Sure.
We're just 11 years behind.
Yeah.
Look, Japan, the Bank of Japan, and we've talked about this, in 2007 said no more bond buying.
Right.
No more QQE. They had the extra Q for qualitative and quantitative easing. No more bond buying. They were at 80% of the GDP on their balance sheet. Today, they're at 136. So they clearly bought more bonds. So the idea that the Fed isn't going to 136%, no, they're going to 136%. They're going to buy more bonds. They are not going to shrink their balance sheet.
Right.
They might for a month or 2 months or 6 months, but over the long term. And the amount of money creation that is coming, because one point I will agree, I don't like to agree with Jamie Dimon, but one thing I will agree with is the response to the hurricane, the FEMA kind of disaster relief that's going to be required after this hurricane is going to be monstrous. I mean, it won't be as big as the stupidity of what happened in the lockdown stuff, where people were like, "Oh my God," and that was just an excuse for the cult of Kelton MMTers to show how bad their theory was. It's idiotic. We can print unlimited money and it does no impact. I mean, no impact like the fact that housing prices went up 40%, 40 in 12 months. You think that's normal? You think that's a good thing? You think it's a good thing that the average family has no prayer of buying a home in their 20s? You think that's good somehow? And it just makes me angry.
It makes me angry too. We're going to talk about one real world consequence here of what the Fed does, right, when they're injecting and withdrawing liquidity, right, out of the market. We're going to talk about employment here, and we're going to talk about layoffs, right, a potential side effect, right, of this economic hurricane. So I just want to kind of set the scene here with a couple of charts. So, one thing to point out is that unemployment remains historically low, right? So on this chart on the left, we're looking at U.S. initial jobless claims, and then we're looking at continuous jobless claims. That thick blue dot, for those of you who are following along on video, that's 2022, and we're looking at data going all the way back to 2013. Historically low, right? And JP Morgan, actually speaking of Jamie Dimon, I think recently came out and said they expect unemployment to remain around 3.5%, which is below the theorized, neutral rate from unemployment in the U.S., which economists said was like 4.5 or 5% previous. So it's historically low, although it looks like it's turning around, right? So we've got ADP data coming out here, which shows change in non-farm private employment. That's in May, and that is slowing, right? Drastically, you can see, especially compared to the last, going back to May of 2021, right? This is the lowest print, by half, at least in some time. And you can actually see for small businesses that actually small businesses have been shedding jobs since February of this year. And the last thing, kind of data point to look at here is that there's a Bloomberg story count mentioning hiring freeze, right, which is starting to peak. And the last time you saw that happen was obviously March of 2020. Now, those levels were much, much higher, right, by at least 3 times. But you're still starting to see that trend reverse. And the reason for this
point is again, that's like when people compare equity returns over the last 20 years and call that normal.
Yep.
No, there's nothing normal about the 13 years of QE induced steroid jacked up returns. Those are not normal. And so this print here on hiring freeze is orders of magnitude larger than average. And you got to take out the outliers of kind of when people were forced literally to lock down and look at normal times. This is 3 to 4x normal times. And it everyone says, we're going to avoid the recession. Really? Like, how are we going to do that? I mean, recessions happen. They're actually, again, like winter. They're a good thing. Winter is a good thing. It cleanses. We need the bad companies to go away. We need the frauds to be exposed. We need the bad actors to go to jail. And yes, it has consequences, and the consequences are, yes, people lose their jobs. But the amazing thing, try to look at every bright side in every dark storm. The amazing thing is during these dislocations, some of the greatest companies in history have been formed. And some of the best investment opportunities that you could ever have happen. Mostly because you get to buy stuff on sale. Valuations in the business I'm in, venture capital, are collapsing. I mean, like collapsing 60, 80% lower. And that's healthy. And look, we had this conversation at IC. It's like, some of those decisions we made 6 months ago, 4 months ago, we like everybody, we're drinking the Kool-Aid a little bit. And it's painful when you have a write down, but for a good company to get to buy more of it at a really good price, awesome. That's how you make lots of money.
Well, and let me maybe speak to this from the employee side of view as well. Like this is my take on what's happening here. So when you hear about the Fed injecting liquidity into markets, I read that as, they're injecting demand into markets because when they say they're injecting liquidity, they make it easier to borrow money, right? Which is they're injecting credit into the economy. And when you inject credit into the economy, people spend that, and businesses read that as demand. Right. And so when there's a whole bunch of demand inflowing to businesses, which has led to this mania breakneck pace, right? If you've been in any sort of, honestly, even just, even large companies, but certainly startups for the last 18 months, crypto, tech, whatever, it's been this crazy pace of higher, higher, higher. We got to go out and capture all of this demand. Well, the Fed is now taking that demand out. So companies right now are trying to assess how much of that demand was actually organic, real demand, and how much of that was just liquidity-induced demand from the Fed. So, you're starting to see these, kind of bellwether companies. Let's talk about bellwether companies in our space, right? So Coinbase, I know they've taken a lot of flack for over hiring or whatever, but they're kind of announcing hiring freeze, layoffs. They're rescinding some offers, right? This was news that kind of came out yesterday. Gemini announced that they're doing layoffs of their workforce as well. I believe, let me check this. 10%. Make sure I got this right. 10% layoffs. And, there's some pushback, right? People are saying, well, blah, blah, blah. Why are these companies doing this? Because they're responsible. Those are our bellwether companies. let me tell you this. Maybe there are some companies out there that are just growing so fast that they don't need to be doing these sorts of things, et cetera. I would say, though, that if you aren't at least looking at a hiring freeze, doing some assessment, then you're not being responsible, frankly. There are some companies that are the exception to this rule, but like good leadership right now should be looking at, payroll expenses and saying, we want to make sure that we're taking corrective action now so that we don't have to do it in 6 months.
Michael, stop talking like a logical human being. Okay. I mean, this crazy notion of profits and cash flow. What are these crazy concepts you're talking about? Responsibility. No. We live in the world of irresponsible actions, right? Yeah. I want to lose as much money as possible, right? That was a badge of honor for the past 2 years. Think about this. Yeah. It was literally a badge of honor for a company to lose more money on the bottom line, as long as they could show that their revenue is rising. Mm-hmm. Okay. Now your revenue growth is down. Now what? Now I'm going to lose a lot. And that spigot, which was, I'll just go raise more money, is turned off because investors don't really want to just give you more money to blow. And it is like a light switch. Back into, again, just being old, you've seen this before. Right? 2001, I remember the story saying, Wall Street Journal, suddenly the quaint idea of profits is hot again. And you're like, what do you mean the quaint idea of profits? Profits are the purpose of business. Businesses, particularly the stock prices of businesses, should not rise if they don't generate profits. And, yes, there is the 1 in 1,000 example where people say, they spend and spend and spend, Amazon, we spend and spend and spend. And then when we want to turn it on, we'll be able to make profits. Yep. He made that happen. But the average company has no prayer of doing that, particularly if your revenues drop. And revenues collapsed, I think 27% year over year at Coinbase. And look, we still own a little Coinbase. I'm still a big fan of Coinbase. I know the maxis get all mad. They're like, no, everything needs to go into cold storage. Everything needs to get off exchanges and into cold storage. Okay, fine. I've said it before. My dad never doing cold storage. He's just not doing it. And so he's going to have a Coinbase account, and others are too. So how do you fix that? You fix it by being responsible, to your point. You right size. And part of my problem with all the employment data, though, is I think it's all wildly overstated because of this rule they have about when people turn 65, they take them out of the labor force, even if they're still working. Like, well, no. If somebody is working, then they're in the. Oh no. They reach retirement age. They're no longer in the labor force.
Wait, really?
Oh yeah.
That's in there.
Yeah. That's why. Look, if you look at the labor force participation rate. Oh yeah, Michael. This is great. If you look at the labor force participation rate, that's the only thing that has bailed out the economists over the last, or the policymakers over the last decade. And it's because the boomers just keep turning 65 all the time. And so they pluck you out of the workforce. And so therefore, if the workforce is smaller, then the employment numbers are higher.
That seems bonkers to me.
That seems like that should there's all kinds of bonker stuff. It's like you realize that most of those jobs that get reported at the end of every month, the jobs report, a huge percentage of them are actually not counted. They're not jobs that are actually counted. Like they went and said, yes, you paid payroll taxes. What they do is they have something called the birth-death ratio. Okay. The BLS, Bureau of Labor or Labor, whatever they're, BLS, says, we are 26 months into an economic expansion. So normally in that, X number of companies form, Y number of companies die. Therefore, we have created 75,000 jobs. Like, really? Did you actually count those jobs? Did you actually show proof that they paid payroll tax? No. It's just a model. And at the peak of the lunacy, like 3 years ago, remember when we were seeing those gigantic numbers right before the recession in 20? It was like 85, 90% of the jobs number was just fake. I mean, it's just made up. And but they're like, well, that's the way we've always done it. And that term, that phrase, well, we've always done it that way, makes me crazy.
Yeah.
Right? I mean, I worked at a university, and that's what they'd always say. Like, well, I need to go to New York. I'm like, okay, your per diem is $168. I'm like, I can't even stand the YMCA for $168. Well, that's the way we do it. Like, okay, well, we're gonna have to find a way around that because I can't do my job if I can't travel to New York and meet the managers. And we did find a way, but it reminds me. I tell the stories. You've heard the story about the monkeys. Mm-mm. So the guy did the study before PETA, right? So they put these 5 monkeys in this glass room with a ladder in the middle, and they put a thing of bananas, and the monkeys would climb up to get the bananas, and they would take this fire hose and they'd blast them until none of the monkeys would go after the bananas. And then they'd take one of the monkeys out and put another one in who had never been hit with a fire hose. And he would try to go get the bananas. The other monkeys would tackle him because they didn't just blast the monkey that was going for the bananas. They blasted them all. So after a week, they've got 5 monkeys who have never been hit by a fire hose, and they won't go for the bananas because we've always done it that way.
Yeah.
And that's kind of where we are with all of this statistical stuff. Oh, we've always done it that way, so it's okay. Like, no, in today's world, we have the tech to know exactly how many workers. The other one that gets me is this JOLTS number. And, Jim, if you're watching, I'm paraphrasing here. He talks about this JOLTS number. That, job openings. Like, oh, look how high the JOLTS number is. How many job? You know why that is? It's because in the gig economy, a company doesn't just advertise in their local market anymore. They advertise county by county. There are single jobs that are being posted hundreds of times that are getting counted in this, openings number. Like, that's one job. It's one job. You can't say it's lots of jobs because they're posting for it all over the country. And you need to fix that. The world is different.
Yeah. I completely agree. And, one thing as well, I mean, people should just have a healthy mistrust of data, I think, in general. Like, if you've ever dug into your company's data, so I used to be a consultant, and when you dig, it's like, that thing crap in, crap out, even at the company level, right? I mean, the data that you are working with, I actually have a huge mistrust of businesses that say we're data driven. I think that's,
I love it.
I think in general, that is everyone likes to hear that, right? Oh, data driven, not fallible to human judgment, shit like that.
That's what the Fed says all the time. We're going to be driven by the data, but you make up the data. I mean, and I used to tell this story too. You read the Wall Street Journal. Actually, no one reads the Wall Street Journal anymore. I mean, I used to read the Wall Street Journal, but you read an article where you actually have knowledge. And you're like, oh, that's bullshit. That's
the Dunning-Kruger effect.
Right? And then you go to but here's the thing, then you go to the next story, one column over, and you're like, oh my God. And you circle it and you cut and you send it to all the people in your company. Look how smart this is. And someone else is going, well, that's wrong, that's wrong, that's wrong. So if this idea that, to your point, that all the data is good, it's just not. And no, I'm not. Look, we need data. We need to collect it. We need to analyze it. But healthy skepticism is really important.
This episode is brought to you by Blockdaemon, the world's leading blockchain infrastructure platform. Blockdaemon's mission is simple. Make spinning up a node so easy a 5-year-old could do it, and so secure that any chief compliance officer in the world could sleep easy at night. In plain English, Blockdaemon allows anyone, whether you're a crypto native fund, a financial institution, a DeFi protocol, whatever, to participate in crypto more safely. For some, that can mean participating in governance. It could mean gathering real-time and accurate data. It could mean generating yield through staking, Whatever it is, when it comes to crypto, infrastructure is edge, and there's simply no better edge offered than the one from Blockdaemon. Blockdaemon supports a range of services on over 50 protocols, and that's a growing list. They have multiple layers of risk mitigation that include regional and data center diversity, 24/7 human and automated monitoring, a full-service team of engineers to avoid technical difficulties, and things like slashing insurance. In other words, they literally make it foolproof. If your organization relies on real-time, accurate data that comes from blockchains, please, please, please click the link at the bottom of this episode and go check them out. Again, it's important. Gotta click the link at the bottom, otherwise I won't get my credit. Two more points on this, the unemployment situation here, or layoffs and everything. So the other thing I'd be aware of as well as an employee, or what employees are figuring out as well, right? When the Fed pumps liquidity into markets, that elevates the price of financial assets. That means stock, read stock of companies. And if you are an employee that took a lot of stock, equity as part of your compensation at one of these companies, then just make sure that you have adjusted your standard of living, right, to what you're getting paid in US dollars. Is what I would say.
Yeah, no, this stock-based compensation thing, and there's the whole scam that doesn't count as an expense. It somehow counts as revenue. Oh no, this is one of the great scams of all time.
I just found this out too. This blew my mind. I can't believe.
Unbelievable. I mean, yeah, it's unbelievable. It's so perverted of generally accepted accounting principles that you can have a liability to people, but somehow it shows up as income. And so all these tech company earnings were just inflated. Now, that's because the stock price was rising. Well, when the stock price is falling, that goes into reverse in a bad way.
Yeah.
And to your point, if you've been compensating someone with a little bit of cash and a lot of stock or a lot of options, and now suddenly those things are underwater, to your point, how do you pay rent? And what's going to happen? That's good for people like us. I shouldn't say it sounds predatory, but there are going to be a whole bunch of people that need
I don't think it's predatory. Yeah.
Right. And if you can provide liquidity to those people, and you don't want, I'm not saying they're going to sell all their stock, but they're going to have to sell some to pay the bills. And those markets have a bid ask. And it's, Brian Estes, who we should have Brian on this show sometime. Brian is just this awesome.
Brian does a great job of this. Yeah.
He does a great job doing this.
For those of you who might not be fully aware of this, so what we're talking about here is stock-based compensation. And the way that actually works, right, is when a company issues equity to employees for whatever reason, that actually gets recognized on your P&L, your income statement, as revenue, right? And people have this idea that it's not a real expense because it's not cash out of the business. It is cash out of the. It is a real expense, and you understand that when there's like a liquidity event, right? So let's say you go public, right, and there's a valuation. Well, that valuation gets divided by the number of shares, right? So when you issue shares, you are increasing the denominator that market cap or that value that investors assign to you gets divided by. So everyone that's an equity holder in the business, that's a very real cost, man. That is a real cost, and people might not have been paying attention before, but they certainly will be.
A giant loss. Look at any of these companies that just went public or did a SPAC merger. Look at their first quarterly profit and loss, and it's billions. I mean, billions of loss, but people don't penalize companies for this. And I don't know. It's all very bizarre.
This is just a challenge that's going to have to get worked through because, one of the challenges I think at Coinbase as well is they've got like 5,000 employees right now. I don't have these numbers off the top of my head. They probably hired 40% of those, I would say, over the course of the last 18 months.
Yep.
Coinbase is trading a little above what they did at their last private raise, their valuation. Yep. That means that most of the people that took stock-based compensation in the last year or year and a half, which is probably like half the company, that's underwater. So, I mean, that's really difficult for morale at a company as well. Because you take that stock, you expect it to go up, and it's pretty devastating when that works in reverse. And I think the way to read what's going on right now is that there is a push-pull in between employers and employees, right? There's a push-pull between the power that employers in the company level have and employers at the, employees have. I think it's been, and it's good, right? It's good when it kind of moves more in favor of the employee in general. Like, we're all people here. We all want to live and have certain rights and salaries and whatever. But it probably moved a little bit too far in the way of the worker. And now I think it's starting to shift back. And something that caught my eye actually was I don't know if you saw this declaration from Elon Musk, but Elon Musk, he said to Tesla executives, return to the office or we're letting you go. Basically, if you aren't in the office for 40 hours a week, we'll expect that you don't want to work here. Apple actually issued a very similar thing. They got pushback from their machine learning team, which is like internally within Apple. They're like the untouchables. And they were like, well, yeah, you don't have to go. You don't have to return to the office, but you do if you want to work here. So I think what you're starting to see here, these like little data points.
But that's just stealth layoffs, right? That's layoffs without announcing layoffs.
Yeah.
And I don't know. We are definitely in a retrenchment, and retrenchments are painful and recessions are painful. But that's disingenuous, right? If you're going to lay people off, just say you're going to lay people off. But saying, well, there's a legal thing too, right? Which is saying, well, I didn't fire you, so I don't have to pay you, I don't have to pay you severance. You quit because I said you had to come in the office and you decided not to come in the office. So it's your decision. Yeah, kind of.
Kind of. Well, so there's this so I think there's a lot of truth to the narrative that, these older, kind of white guy boomers just are worried that their employees aren't working hard enough. And that's why they want them in the office. I can tell you, so at Blockworks, I would also probably prefer people to be in the office more. And it has nothing to do with that. I'm very aware that people work extremely hard and I'm not worried about productivity in the slightest bit. But I am conscious of there is something about people being in a room together. I'm telling you, for camaraderie. And all these people who are saying a remote first, workforce, you don't give up anything. I just don't think they're being totally honest with themselves. Like, you do sacrifice some amount of culture. There is something that you lose without people being in the same room, especially in our business where like it's editorial and content and there's a creative element to it. It's just difficult.
Places at once. You can't.
Yeah.
You can't do two things. And again, it's not politically correct, and I used to get in trouble about it. But it's like the super mom fallacy. Oh, I'm raising my kids and I'm doing my job. I'm like, no. You have a job. Someone else is raising your kids. Totally fine. I'm totally great with that decision. That's a decision I made, right? I'm not home with my kids. I'm in the office doing my job. And that's a decision. But this idea that you can do both is physically impossible, right? You can't be remote and collaborative. Now you can, there are tools like we're using right now to kind of collaborate. And now, if you're sitting around together on a Zoom, that's better than nothing. But
you lose something.
The serendipity of you pass someone in the hallway, or you hear other people having a conversation. You're like, oh, I got an idea to help on that. Or, hey, does anybody else, have an idea? I'm just stuck, right? That goes away. Now, tools like Slack and others, I think, can help that a little bit. And there are collaboration tools that have made it better than it was. So it's not quite as stark as all or none, but there are trade-offs, as you rightly said. And it's just physically impossible, right? I mean, you and I are not together right now. You are in a place I wish I was, and I am in a place that's like super hot. And just because you're in the Pacific Northwest, which I was there for about 12 hours on Wednesday. Day trip to Seattle. The bad old days of business travel are back. The bad old days where I did day trips for.
Guys, before this recording, Mark was telling me about how he did a day trip to Switzerland. Was it 17-hour day trip? Yeah, it's a long radius, big radius for day trips on Mark.
Trip. Yeah. Like I said, the bad old days.
Yeah. So I would just be aware that we're in a different environment than we were. So I would when you get flashed some big equity number that you're getting as an employee, it's probably good to assess if you're getting that from a very large, very well established type company. But honestly, like even Coinbase and Gemini is not immune to market downturns, right? Or if it's this, because this is what happens too. I mean, I saw this tweet that the market cap of some of these tokens is now less than the promised salary for individual developers on each project, right? So that shows you, if you are taking an enormous amount of your salary in tokens or equity, I mean, that can go against you pretty sure, especially when valuations are extremely high. I want to get your take on two more stories here. These are maybe more regulatory type things, but there's a big announcement in crypto is that there's that the FBI is actually looking to indict Nate Chastain, right? So he was the former he's a former OpenSea executive. I think he was head of he's getting charged with insider trading for NFTs. Yeah, sorry, it's the Department of Justice. They've indicted former OpenSea head of product Nathaniel Chastain. So basically, so just to set the scene here, the accusation is that he was accused of buying dozens of NFTs, right? That he had prior knowledge that the assets would be featured on the NFT marketplace, right? So the basic idea is that OpenSea gets an enormous amount of traffic. As head of product, he knew which NFT collections and specific NFTs were going to be featured, prominently, and that could, pretty reliably lead to, an increase in buying, right? So the quote from the US attorney Damon Williams is that NFTs might be new, but this type of criminal scheme is not, adding that Chastain's betrayal and other insider trading crimes would be stamped out, whether it occurs on the stock market or on the blockchain. Now, the counter to this, right, or why many folks thought this wouldn't hold water is that NFTs have not been defined as securities, right? So insider trading laws typically apply to securities. What do you think about this?
Cheating and lying are cheating and lying, right? I don't care where you do it. I don't care if you do it in the bond market, in the stock market, in the grain market, in the commodities market, in baseball cards, right? If you cheat and lie and steal, you should get in trouble. And the initial reaction is no. Securities laws apply to securities. Therefore, you can't charge me with insider trading on the securities laws.
Yeah.
True. But I can charge you with insider trading. Okay. Now that's why it's Department of Justice probably instead of SEC. And you can argue all you want on the details. Well, I wasn't trading securities. Okay. Did you take material non-public information and profit from it? Mm-hmm. Well, kinda. Yeah. Okay. That's what we're trying to stop. And we don't want it to happen in any market because trading on material non-public information is wrong, right? I mean, the average person in a marketplace is dependent on the marketplace being fair. And if somebody has an unfair advantage, that's wrong. So I could probably argue the other side on the letter of the law, but to me, the spirit of the law is very clear.
Yeah, I'm so without any comment specifically on Nate Chastain, who, by the way, I've heard is actually it seems like he's a pretty young guy who made a mistake. So I don't want to comment specifically on this, but what I will say, there are two things that kind of stand out to me here. Is I saw this quote that the law is not an ass, and the other thing this reminded me of, which is basically that even if you're doing something that doesn't conform to the letter of the law, the law will find a way. And this reminds me of a thing that Matt Levine has said about the regulatory apparatus in the US, and he's got this great phrase, everything is securities fraud. And he basically, the idea is that financial markets are complicated. The way that securities fraud is, it's specifically outlined is very vague. And it basically gives regulators some kind of, creative abilities to go after people, right? It doesn't necessarily have to be this, and this, and they'll kind of go after folks they think are bad actors. And that's what this kind of reminds me of. If you do things that, are against the spirit of the law, then eventually that kind of catches up with you.
Here's the thing. This is Martha Stewart all over again.
Right.
What Martha Stewart did is wrong.
Yeah.
But did she actually even do it, right? She had this guy that she relied. She's not a securities expert. She had this friend.
Martha Stewart? Kidding me.
Yeah, she's a very smart lady. But my point is that she was not a stock trader, right? She had this friend, and this friend said, "Hey, buy some of this." Now, should she have stopped to say, "Well, friend, do you have material non-public information that you are giving to me? And why are you giving it just to me and not to everybody else?" But she didn't do that. Okay, does that happen every single freaking day? Every day. Yes, every single day. Do people do it for way more than she did? Absolutely. Does that make what she did right? No. Should she have gone to jail? I don't think so. I think she should have been fined, should have been chastised, maybe do some public service, but holy moly. The crime, punishment didn't fit the crime in my eyes, but high profile. And, again, you can talk about non sequitur, but, what Hillary Clinton was doing in the cattle market was worse than what Martha Stewart was doing. Now, I will argue that the person doing it for Hillary was the really bad person, that Hillary kind of knew, when you're getting free money, that it probably something bad is going on.
You don't really want to look too hard.
But you don't want to look too deep. So she never got in trouble. But a whole bunch of people could get in trouble. And I feel badly for this kid, or guy, I shouldn't say kid, I don't know him. But I feel badly because other people, I am certain, did way worse. But as we've talked about, we are in the then they fight you phase. We are in the then they fight you phase. And they, meaning incumbents through regulators, are going to attack. And this is just another example of an attack to say, see, this world is full of fraud and bad stuff, and you need to stay away. So NFTs are bad and digital assets are bad. And wait a second, how is this different from all the other insider? There was a whole movie, Wall Street, about insider trading. And then there was Ivan Boesky. And there are always going to be people who break the rules. Full stop. And not all of them get caught. And the ones that do get caught, they should be punished. And I do believe what he did was wrong. I don't know how wrong. I don't know how vast the network of insider information was, but clearly, if you have material non-public information, you shouldn't act on it.
So here's what I would say, that I think a lot of people in crypto are sympathetic, but maybe sympathetic for the wrong reason. Because if I had to, I think what a lot of folks might say is what he did was probably wrong and maybe he crossed the line. But I think it's nothing compared to what some other insiders in the industry are doing. Right. That's what I think they'd say. And that's a problem. And there's a note here that got issued from the Attorney General of New York, Letitia James, very recently, might have literally even been today. But, so usually when these kind of notes, the headline is, right, she's warning New Yorkers about cryptocurrency investments, right? Yeah, sometimes investments lost hundreds of billions in cryptocurrency investments as the market reached new lows. Now, whenever these sorts of things come out, my heckles get up, right? I will admit, I'm like, well, how much money was lost investing in the stock market? Then I looked at some of these. More. Right. And that's true. So I looked at some of the risks, right, that they're saying here. And the first one, highly speculative and unpredictable value. That's the one that always kind of gets me. It's okay. But, then I started to read, some of these other ones that they've got: difficulty cashing out investments, higher transaction costs, unstable stable coins, hidden trading costs, conflicts of interest. And while I could kind of get on the defensive about some of this and say, well, this exists, I have to admit some of this stuff definitely are problems. And one of the things about bear markets, right, I think is that we as an industry need to look at ourselves, right? And the government is going to come after crypto, right? They're not, they say, oh yeah, we're friendly, we're accepting, but they're really not, right? Biden's coming out and actually something just got passed in New York, right? Where they're essentially banning Bitcoin mining, right? Except for the one company that this applies to that's already grandfathered in, right? So there's going to be an increased amount of scrutiny on crypto. I think these, what happened with Nate today is just the tip of the iceberg, right? I think you're going to see more actions like this.
What you just read is boilerplate from traditional securities.
Yeah.
There are hidden fees, hidden charges, inability to cash out. Try cashing out of an illiquid penny stock.
Yeah.
Right? Without losing money. I mean, Peloton, speculative, high volatility. Peloton lost way more than most crypto assets. Way more.
Yeah.
Not more than Luna. But by the way, just one little thing. I know we don't want to talk about Luna, but how is it? You said that the industry, the industry have to be better. We do. Don't self-proclaim yourself a lunatic. No, I don't aspire to be a lunatic. I don't. Yeah. I want to be an intelligent person, a rational, reasonable person. I don't want to be a lunatic. Are you joking? So that's the nonsense that has to stop. Right? This idea that oh, ha ha ha, wink wink, we're so dumb, we're smart. Don't be dumb. Just be smart. Just be smart. And yes, you're exactly right. Do fees need to come down? Of course, but not tomorrow. It was like, oh, we need zero trading costs, zero commissions, like stocks. It took stocks 200 years to get to zero.
Yeah.
And it took the better part of the last 20 years to get from, kind of the fixed rate super high, like real. I mean, you want to talk about bad stuff going on? Go back 25, 30 years into what happened in the stock market with halves and quarters, and you could drive a truck through the spreads before decimalization. So we don't need to be there immediately, but we do need to constantly get better.
We do need to constantly get better, I think is the point. And I think if we're being honest with ourselves, a lot of that need to be better has dropped off the face of the map in the last 6 to 18 months. Is this mania phase has gone through. And what I would say, what crypto needs to do to win, really, we need to win hearts and minds. And we're not going to win it doing stuff like this. I think, it kind of sucks, right? Like the new kid on the block, you have to not just be as good, you have to be better. And I think that you have to be better both in terms of the products and services that crypto as an industry produces. But I think there's an optics element to things as well. And crypto just has never fixed the optics element. And I thought during this last bull market that it just wouldn't matter and you power through, but you know what? No, I think it actually does matter. You need to
see again. We're beating ourselves up a little too much in that every new market in anything, right? Whether it's postage stamps. I was a stamp collector when I was a little kid, right? Stamp collecting had all kinds of scams and frauds, coin collecting, gun and knife collections, antiquities. I mean, the big hedge fund manager, I shouldn't pick on him, but Michael Steinhardt got in big trouble for some rigging antiquities sales. And so any market, people are going to look at it and say, how can I exploit that for my advantage? Or, hey, this is a speculative market. Look at the roaring 20s in stocks. You had people, the term bucket shop exists for a reason, right? There were people scamming people by lending them money to buy these little penny stocks and pumping them up, and they were feeding the ducks. And we just write that off as ancient history, but now it's happening in NFTs. Look, are JPEGs of animals or people interesting? Yeah, some of it's art.
Some of it.
A lot of it is just Me Too-ish kind of. I want to be in the bubble. But is the idea of NFTs or digital property rights going to be with us forever? 100%. I don't know if you heard the song Crypto Boy, this TikTok thing. Look at it tonight, and you'll thank me later because you're gonna have it stuck in your head now for all weekend. But go to TikTok and look at Crypto Boy, and it's this song that this woman.
Oh, I have seen this actually.
Yeah. And it's a catchy tune. It's as good as Avril Lavigne in her prime. I actually like the song, but I have composed, I haven't done it yet, but I have composed, what my daughter's like, you are not going on TikTok. I have actually composed the open verse challenge to say, look, you don't want to hear about my NFTs, fine. But here's the thing. NFTs are about ownership and royalties. And if you had created an NFT, then instead of ByteDance getting rich, you'd be getting rich. Well, guess what she did? Pussy Riot made her do an NFT. So now she can actually benefit. So ownership of things and assets and creative content is going to happen. And the fact that this guy made a bad decision by buying things that he had material, non-public information about, sure. Now, should he get a slap on the wrist? I don't think he should do jail time. I don't know what the Department of Justice rules are, but he should do some community service, disgorge him of his profits, maybe even do a commercial saying, I made a mistake, don't do this.
Yeah.
But I don't know.
I want to depart even from the Nate because I just don't, I don't know him personally, but I'm more talking about like, even when you get, so I'm a huge believer in NFTs. They make an enormous amount of sense to me. And what I would say to you as well, and, like a little thought experiment for those of you out there. Let's say you've got $10,000 to spend. Would you spend it on a really nice suit or would you spend it on a really cool profile picture? And honestly, I know that maybe the older people listening to this is like the nice suit. I'm telling you, if I could spend $10,000 and get some really cool thing that everyone thought was cool, I knew when they hit my profile, it was going to be a status symbol. I would take the profile picture every time. And you can look at me and say, maybe young, but like, how many people see my profile? How many people see me in a suit? A nice suit I'm wearing like 2 times a year.
Rolex, baby. I mean,
right.
People spend $200,000 to buy a fancy watch. Why? So when they walk down the street on those occasional moments where the cuff doesn't cover it up, someone sees it and says, oh, he's really cool. He's really rich.
Right.
No different. But it's even bigger than that. One, it can be, oh, you're cool. But also it can mean, oh, you're one of me. You're part of my community. I'm going to help you. I'm going to bond with you. I'm going to include you in some cool stuff that we're working on. So there's a community effect. And when the digital age allows communities to become economies, now that profile pic actually has way more value than a suit. A suit, maybe someone whistles at you when you're walking down the street or someone says, "Ooh, yeah, they're sharp." Or in an interview, maybe you get the job because you look better than the other people. But I'm with you that our identity is moving into the metaverse, right? That physical world and the digital world are integrating. And therefore, spending capital to enhance our digital image. Why do we all work so hard to curate our content on our LinkedIn or our Twitter feed or whatever it is? We work hard. I mean, I didn't pick my profile. Now, I don't have an NFT or a Bored Ape or whatever. I mean, I have a cartoon of myself and my son. I do that intentionally. Why did I do that intentionally? Well, someone said, "Oh, you look good in that." I'm like, okay, good. I'll use that one. But there's also, why do I include my son? Well, there's a reason. And so, should I pay the 10 grand to or 100 grand or 200 grand to buy one of the communities? Well, not for me personally yet, but I totally agree with you.
I think the thing about NFTs too is that it is a status symbol. It is also a community thing. Like this is where analogy, I think it's more than just the fancy suit. It's more than just the Rolex. It's weirdly like an online country club almost because it gets you 100%. Access to this community. 100%. Now, I think the thing is though, right now, what a lot of people look at NFT. I mean, let's call a lot of NFTs what they are at the current time. Doesn't mean they will always be. They're pump and dump schemes. They're pumped, run by insiders, and like they pump it all up and then people dump it. And that is not good behavior. That is just, it's just, Yeah, I just think I'm also clearly, right. I spent hours of my life debating this with people, right? That what crypto is today is not necessarily what it would be in the future. I'm obviously a big proponent of the future, but this is the time, right, to improve on stuff that we know probably should be improved
Amen.
on.
Amen.
Yeah.
Best work gets done in bear markets.
I'm with you. All right, Mark, that's all the time we have for today. This has been a fun one. As always, best hour of my week, and I will see you back here same time next week, my friend.
Enjoy the weekend, my friend.
You too. Cheers.